Welcome to Subramoney. Some of my mistakes, some of my learnings, I keep doing this time and time again. So this is the latest version, because there are a lot of old versions. So one thing which I realize is the best shares you may already own. If you've taken a lot of trouble to create a portfolio which is old, some of the best shares you may already own, and if you own, there is no harm in picking up more of that. So for me, I have absolutely no problem picking more of Siemens or more of Supreme Industries or HDFC Limited, now HDFC Limited, HDFC Bank, even ICICI Bank now, or Nippon AMC, HDFC AMC, HDFC Life Insurance. I keep buying, selling, holding, doing all kind of things. And whenever, here's a caveat, I have these shares, I have bought, I trade, I sell, I do everything. So it is not to say that this is permanently there in my portfolio, but good chance that something like an HDFC Limited has been in my portfolio now since 1978, right? So you're talking of 22 plus 22, 44 years. Or something which has been there even longer would be something like Hindalco or a Larsen and Toubro, which is older than that. So some of these shares have survived over long periods of time. So the best share, if it is already there, there is absolutely no harm in adding more of that. Instead of saying, oh, I already have it. Let's say I have 200 shares of Larsen and Toubro, bought long back, and it has grown to now 5,000 shares or 8,000 shares or 10,000 shares. There is no harm in picking up 200 more shares or 300 more shares or 500 more shares, instead of keeping on looking for better and better shares in the same group. You won't find it, or your portfolio will get too long, right? So some of these things, okay. So this is one important thing. Second, adding more makes sense. Also, buying more when the price is going up makes sense. I have done that in the past. For example, right now I have Zomato, which I bought at 90, sold at 80, bought at 47, bought at 57, bought at 68, bought at 75. Then right now it is at 65. So I bought it at various prices. I don't even know what is my average cost, but I believed in that. So similarly, I bought Indigo at I think the best price I must have got is sub 800, maybe 700 and odd or 800, and the worst price that I must have paid for it must be about 1900, right? So I paid all kinds of prices. So it is possible that you build your portfolio over long periods of time, then you buy it, and then you're hit by a recession or you're hit by a COVID, the price will fall. Obviously it will fall for an industry like an airline. That's a time for you to believe that, okay, when it revives, it's good for me, right? So one is being ready for something like that is important, and buying adequate quantity. Sometimes you like a share, you put in a lot of effort and you see it, and then you go and buy a very small quantity which is insignificant. It makes no difference. So don't do that also. I mean, these are all mistakes which I have made. So it is for you to decide how much of this you want to use. Don't overlook something saying, oh, this the market should know, right? So the example for this is, there are 4 economists standing, and there's a 2000 rupee note lying there. So each one thinks that, oh, the other would have known, so they don't do anything. Another person, ordinary person, comes along and he sees the 2000 rupee note, he bends and picks it up and goes away. Then these economists are saying, what happened? So they say, oh, we thought there was perfect information, everybody knew what was going to happen, so we thought there is no value in this, must be a fake note or something like that, so we didn't pick up. Don't do this. Sometimes there is value very obviously staring at you. Don't think that you should not pick it up. Just pick it up. It could be a good 2000 rupee note, or at least it's the effort of picking up a note. That's all, right? So don't think it is too obvious. Everybody would have known. Not true. Everybody does not always know, and even if they know, it might still add value. So if sometimes what belief you hold could be tested very hard. Like, for example, many of us believed that PSU stocks cannot create value. But I met somebody who said PSU banks will create value, and here and there. So I have luckily last year picked up a lot of PSU bank shares. sometimes your tests, your beliefs will be tested, right? So you have to be very careful. Sometimes you have to bend with the wind, and sometimes you have to resist the wind. So it's your choice as to whether you should have added more PSU or said no, PSUs anyway will destroy wealth after 2-3 years. In 2025 they may have destroyed wealth. This is what has happened traditionally. So you can take a view, or you can take a view that the earlier government did not allow the PSUs to function as independently as this government, and therefore this government, therefore the shares are worth buying. Or you could take a view that maybe they are talking up the share for doing something, so I will not be buying. Any view, but take a view, stick to it, and be ready to change your mind when that needs to be done. If some stocks are cheap, they are cheap for a particular reason, and that reason will be fairly obvious. That is why they have remained cheap over a long period of time. This would have been true for PSUs say a year ago. PSUs were really cheap and people thought, oh, this is a rogue promoter, we don't know when they will come out with a new issue, so we should not buy. For example, Coal India today is 230. If the government comes out with a new issue to the public at 190, they would have effectively destroyed a lot of market cap. Rogue promoters are capable of doing this, and therefore I will stay out of PSU. Perfectly right. Or say, no, I think I'll buy PSU anyway. I think Coal India is a good buy at 200 and odd, or 220 or 230, simply because it is giving so much dividend. But you have to be ready to understand the whole process and not just believe that, oh, it is cheap, so I will buy. Sometimes they are cheap and remain cheap. Some shares which are at a premium always remain a premium share. You don't see a Siemens or a Cummins ever coming down, or a HUL ever coming down. They just remain where they are, and they still deliver growth. Nestle still delivers growth, right? So it is for you to decide which ones to hold, what theory to do, right? There is no one theory which works for all at all time. Getting annual reports is not so difficult today. So get the annual reports, download it, read it. You go to the website, you have the analyst calls, you know when the next analyst call is going to happen. You can also attend it online. So even whether you're sitting in Dehradun, Guwahati, Salem, Coimbatore, it does not really matter, right? You can attend those calls, you can come with your own views and decision. The reason to be in Nariman Point to earn money is gone, right? Geography is now history. So you can sit there and do it, but please do it. Don't just buy it because somebody else told you. You cannot buy the conviction. So if you are convinced that the food delivery business will do well, maybe you will go and buy a Zomato. Or you say, who will pay 200 rupees for a 100 rupee item? Nobody will buy it. That you could be right. We are never right or wrong in absolute terms. It's only in relative terms we have to decide. I remember in 1997, 96, 97, 98 maybe, when the phone call used to cost 32 rupees for an incoming call, or 32 rupees for an outgoing call, and 16 rupees for an incoming call. I used to wonder who will ever use a phone, right? Then prices dropped, and today you can't imagine. I don't think I know anybody who does not have a phone, who is above 12, 13 years of age. Whether they are domestic servants, whether they are drivers, whether they are CEOs, it does not matter. Completely cut through class, and it is available at a ridiculously low per unit cost, right? So you have cheap phones, you have expensive phones, you have very good service providers, you've got decent service providers, you've got a premium package, right? So we are not spending as much on phones as we used to. I am not spending on phones or phone bills as I used to spend in the 1980s and 90s in my office, right? So it has definitely cut down costs. So will we use food delivery? Will we use grocery delivery? Will we use Ola, Uber? I don't know. We've laughed at everything, saying, oh, who needs this service, right? But everybody has used these services. So maybe 5 years from now, you could be using a Zomato or a Swiggy, which you think today is no longer necessary. So similarly, if somebody came out with a service saying, if you are going from Bombay to Delhi, and if you can give us a forwarding address, we will deliver your excess baggage there at 100 rupees a kilo, not at 500 rupees a kilo as an airline charges. Will there be market for it? Yes. Will we look at it and say, oh, how will they compete with an airline? We will come up with all our own theories, and then we ignore it till it becomes so significant. So don't be skeptical about anything. Don't judge on the basis of what you do. I may not use a food delivery service, but my family might be using, my daughter might be using, my daughter-in-law could be using, anybody could be using, right? So look at who is using. Is that market growing? Is that market of people who are prosperous, who don't think twice about spending 50 rupees on a delivery or on delivering a 30 rupee item, right? Look at that. There could be a market. So look at all that. Don't judge just on the basis of your own experience, because your own experience is going to change. I didn't think the telephone penetration would be so huge so quickly, right? By 2006, 2007, maybe 2010, everybody started having it, and 2022, I can't imagine anybody not having it. Very many people with multiple connections, right? Fundamental analysis works, it always works, but some businesses could be in the early stage building up market share. So if they're building up market share of 50-60%, it could be a good time to get a sneak preview and see what they are doing, and put in small money and say, okay, the day they hit some profitability, I will go and buy more of it, right? So you can dip your feet or your toes, then your ankle up to your knee, and see whether it is working for you. So don't discount anything totally, or don't fall in love with anything totally. Somebody can come and completely break and destroy it. Remember, look at the modes, keep looking at all of that, right? So sometimes you take your eye off the ball, there's a chance that there will be there'll be a mishap. Like, I don't know whether if you understand enough Hindi, it says nazar hati durghatna ghati. If you take your eyes off the road, there could be an accident. So be careful about that. All businesses are about a collection of people. So if you are investing as a venture capitalist or equity contributor to a startup, then you have to be careful. You have to ensure that the people are good friends, but there is always a boss and subordinate relationship, right? All those things should also be in place. So look at all that, look at the people, look at the ideas, look at what is happening, and that will give you better hope than looking at just the numbers. So look at the numbers, yes, but look at the other things also. Similarly, for a bigger business, see the business, whether you admire that business. Don't just go by numbers. So if you think it's a hotel business, or it's an airline business, or it's a leisure business, see whether there is enough traffic in that, right? Whether enough people are going for that. If it's a very expensive hotel, are people staying there? Go once in a while to check out that place and see how is the occupancy. Check out once in a while, right? So some of these, ultimately you're investing in businesses. So check whether these businesses are working. Once in a while, do a dipstick. Having an advisor is useful, and what that advisor should do for you, you should know, because some advisors are able to influence your behavior and some are good at managing money. They are two completely different skills. You could have an advisor who is very good at advising and tell you what you should do to achieve your goals, and make sure that you don't stop your SIP, increase your SIP, or do some monkeying around with the portfolio. He is not the portfolio manager, and he could take you to a good portfolio manager. That is that advisor's role, and this is the portfolio manager's role. Don't blame the advisor if the portfolio manager is not performing. Blame him for the process by which he chose him. So understand the role of your advisor. It's like going to a gym. The role of the trainer is to make sure that when you lift, whether you hold the grip like this or grip like this, or right, all those things matter, right? Whether when you're doing a chest press, is the pressure on your chest or is it on your shoulder? A good coach will be able to do all those things. He will not be able to, your body won't get built because you got a good coach. You will build a good body because the coach was good, he said the right things and you listen to him. This combination is required in the investor, advisor and portfolio manager. See whether you're building those things. I've always used an advisor from 1979 till 2022. But it's your choice. Some people think that they can pick up ETFs and some passive funds and that will work for them. It's your choice. I do a combination of everything, right from PMS, which is very small, and mutual funds, direct equity. I have the full range, right? So you have to make your own choice. Sometimes I have lost money by selling early. Infosys, I made the mistake of selling early. Sometimes I make the mistake of holding on for a long time and then and losing money. So all this was learning. So nowadays I don't let my losses run. I let my profits run deep. Right? I have made a mistake of selling early in Infosys, and I have held on to HDFC Limited and HDFC Bank for an extremely long period of time. I made money by selling MRF at the right time and then again buying it back when it fell. Right? Same thing I've done in LMW. I've done in Bosch. You have to know that some strategies will work sometimes, some won't work. Some shares you sell off and it just goes off, you'll never be able to touch it again. I have then learned that I could keep buying. I could be selling when it is coming down in lots. I could be buying when it is going up. Doesn't matter. There's no best price to buy and best price to sell. If you're making money, it's good for you. Sometimes selling early is hazardous, sometimes holding too long is hazardous, right? Both could be right. Sometimes this is right, sometimes that is wrong. Sometimes both are wrong, sometimes both are right. So it's a very liquid state of the market. So you have to choose what suits you and what does not suit you. In equity, there is you get rewarded for sitting for very long periods of time doing nothing. That's also not easy. You're itching for action, you want to do something, then trade in 100 shares or 200 shares. Let's say you have 10,000 shares of XYZ, you trade in 200 shares, you trade in 300 shares. There is some action. It does not mean you have to trade in 10,000 shares. Reduce the ticket size when you are itching for action, because don't disturb your core portfolio, which is anyway doing well, right? So don't do that. Holding for the long term can mean holding for decades, right? Not just for a few years. So when I'm talking of holding for a long term, what it means is you buy a share because you like it and then you keep monitoring it for some time. After some time, that monitoring is not needed. It is exactly like planting a seed. When you plant a seed, the seed doesn't look like the final output tree, the mud doesn't look like the final output tree, the water doesn't look like the final output. What you're going to get is a sapling, which you have to again nurture for some time, and after 10 years or 5 years, 7 years, you don't need to do anything. The tree will go and find its own water and it will live. You don't have to water it, you don't have to put a fence protecting it from other animals, etc. Right? You don't need to do any of those things. Exactly like that for your portfolio. When you buy a share, monitor it for some time, look at the quarterly results, etc. Then you like it, you keep it. You don't like it, you get rid of it. So this also means that when somebody asks me, can you give me some 10 shares which we can buy and keep it for the rest of our lives, I'd say it's not such an easy decision. Holding on to a share for 40 years means, at least in the initial 5 years or 3 years, it means 12 decisions to keep it, because every quarter you're seeing what is happening. Did they say something and achieve it? Is the share price going down? If it is going down, is it going down faster than the industry or from the whole overall market? Look at all those things as parameters. So it's not always a buy or sell decision on day one. On day one, yes, it's a buy decision. Then there are 4 hold decisions every year. So if it is 40 years, at least you have taken 20 decisions, if not 160, saying, okay, this is a problem, but I'll still hold. This is a problem, I'll still hold. Oh, this is a problem, I'll sell partially. All these kind of things happen. Nobody buys, say, HDFC Bank in 1978 or HDFC Limited in 1978, bought 10,000 shares and now holding the whole thing. Whole thing means that 10,000 plus split and bonus and rights and all that. That never happens, because it takes time for you to decide, oh, this is a good company, this is great company. So after 1995, maybe after 2000, I'm not sold HDFC Limited. But 1978 to 2000, of course I had to sell, because you don't know whether it is worth holding or no. It takes time for you to know, learn and establish. There's a book which says just keep buying. So typically you are doing multi-asset investing. Most of you. I'm largely an equity investor, but most of you are investing in equity, in real estate, in gold, in putting some money away in debt funds. You're doing this, right? So if I can create a multi-asset fund for you, which says 60% in equity, 10% in debt, 10% in gold, or some 10% in REITs, something like that, and then you have to do nothing except keep on doing an SIP in that. Whatever is your asset class, just keep buying, because you know that the human mind is capable of surmounting all the problems. So was this Chinese COVID a problem? Yes, but the whole world coped with it, right? You have to be sure about the world's coping mechanism. Some companies may not cope, many people may die, all these things will happen, but the world at large copes up with the problem and comes out of it. Therefore, in the long run, equities make money. But please also remember, almost all equity literature is American. But at a time when America was dominating the world, it could manipulate anything. United Nations and all of them, everybody was listening to them. We do not know what is going to happen in the future. So will this always work? I think so, but I'm not very sure. Position sizing is very important. I learned it from Naren largely, and that was very useful for me, because you could just pick up 200 shares of a company at 80 rupees, and when the price is 400, say, oh, I have 200 shares. It doesn't make sense. You have to keep building a position enough for you to make that effort of doing research, knowing the promoters, or learning about the promoters worthwhile. Otherwise, it's not worth doing equity investment by not committing enough money to the idea which you like. So you should you should go between 5% to 17-18% in any script. Otherwise, it's not worth it. Otherwise, it's just a position which is there. You bought 200 shares, you bought it at 400, it became 500, you sold off. That is not what I'm talking about. When you invest, build a position, learn about portfolio sizing. Find yourself an investment club or investment buddy with whom you can talk, with whom you can chat, maybe who has a YouTube channel, somebody who has Twitter feeds, all that, so that, because this is going to be dull and boring. And to avoid the monotony, if you start trading, you will hurt yourself very bad, right? So build your investment club, which meets every week, every month, every day, depending on your level of enthusiasm, and you decide there, right? So there is no question of you taking away somebody's idea or they taking away your idea. You go, sit there, talk. It's pretty lonely out there, so you need to create your own forums. For us, we had the advantage of going to Dalal Street, so which meant we met a variety or range of people who would all be happy talking about equities through the night also, right? So we could find that in a physical way. You have to do it in an online fashion or in a physical way.